Hello, everyone. I'm Terry Hines. I've been introduced before. I'd like to introduce our new panel. To my immediate left is Jim Ziegler. He's a principal at Rebel Group. He focuses on advising federal, state, and local government and private sector entities on funding, financing, procurement, and the operation of infrastructure assets. He has more than 30 years of experience in investment banking, financial advisory, and strategic consulting. He has particular expertise in public-private partnerships. To his left is John Morton, who's a principal at Global Infrastructure Partners. John joined GIP as a principal in 2018. He focuses on the transportation sector in America, including airports, ports, and railroads, and he's based in New York. And most importantly, he's a fellow Duke alumnus. And to my far left there is my colleague here at Sidley, Ray Atkins. He's widely recognized as a leading lawyer in the transportation field. He's the co-leader of our firm's transportation practice. He advises some of the world's largest transportation companies in high-stakes transportation issues, including transactions, regulatory litigation, appeals, competition, and what the subject you're going to hear from him on today is federal preemption. Before he joined us here at Sidley, he was the general counsel of the STB, which, as many of you know, is the agency that regulates passenger and freight railroads. We have our slide up. Anyway, the overall topic of this panel is what do we do to scale up private investment? And we're going to talk about three broad issues: financing, permitting, and preemption. The first is the perennial topic of financing, which you've heard plenty about over the last couple of days. I want to start the conversation off and ask first Jim and then John, what are the obstacles that someone faces in getting private financing for one of these projects?
Yeah, I think I think the main obstacle that you're going to get in financing, really in any project finance thing, is the underlying credit quality, right? The investors in the private market really have to understand what's the credit that I'm getting, what are the risks that I'm taking on, and if they feel like they can fully understand that and get their hands around it, then they're more than willing to lend at what they feel is a fair rate. The real rub comes in that at what they feel is a fair rate often. And the biggest challenge that I think we have seen that hopefully Brightline is going to create some breakthrough on is that there's just no history of a high-speed rail line covering its capital cost and its operating cost on a long-term basis of a passenger rail line, I should say. Freight rail works, which is why everything went out of business in the 70s. And so I think investors have been loath to invest in these types of things without a lot of government subsidy going on. But hopefully in certain circumstances, we'll now see that there's a model. And we'll also see that maybe the government can kick in some more money and de-risk that asset.
Another one of the issues, of course, is that if you're a greenfield project, you don't have assets that can be mortgaged to the extent that private lenders looking for any kind of collateral. Right.
Yeah, I mean, I think that's true. I mean, I think that if you're a greenfield asset, you sort of build the thing and then you go out of business, you do have a bunch of assets. At that point, you've got the rolling stock, you've got the rails and everything, but you've got a business that isn't working. And that's the real thing in project finance, is that they're not looking at mortgaging rail cars. They're really looking at, is this a good business in the long run?
John, GIP took a somewhat different approach. You purchased an already constructed and operating railroad in Italy.
Yeah.
Why don't you tell us a little bit about that experience?
Yeah, so we do equity investing in transportation infrastructure, energy infrastructure around the world. We have about 80 billion invested. And so when people say, is there money available to invest in things? We bought Sydney Airport last year and arranged about 20 billion for that acquisition. So we can get a lot of capital to invest in things. One of the investments we did in 2018 was Italo. Italo is an operating high-speed rail in Italy, because point between all the cities. Where we got comfortable with that is the network had already been built and a regulatory structure was put in place with access charges and access rights. A group of individuals started to put together this business. It took them about 7 years to get the permitting onto their operations, as well as order their first set of fleets. As they were starting to launch into operations, we came in and purchased the business for about 1.7 billion euros and have operated it since, all the way through COVID. The interesting thing around this business is we've gone from about 30 train sets to about 50 train sets. Our operations are above pre-COVID levels already and continuing to recover to where we thought original operations would be. what were the key things we were looking at as a risk? One, sure, would I build something? We build things all over the world. We've built tens of billion-dollar LNG facilities. So we will build things, but building a rail network is not that far off of some of the risk of building even greenfield toll roads or some of the other things across multiple jurisdictions and carry a host of problems. With Italy, they had already built the setup and the network. They had a track record of operating it, and they gave us a very strong regulatory framework for us to operate within, which meant that our operations were a duopoly between us and the state operator of Italy. We got comfortable with our position in that investment based on a couple of really simple points. One, we were, as a private operator, we were very good at procuring train sets and equipment. We probably procure at a level of something in the neighborhood of 20 to 30% cheaper the incumbent government operator. On a labor standpoint, because we're optimized the way we work with flex hours, a whole host of staffing, we probably operate on an operating basis, something in the neighborhood of 15 to 20% cheaper than the incumbent on like-for-like operations. So we're very comfortable that we can operate. And so the vast majority of what we do has nothing to do with price. It has to do with focusing on just meeting a market price and operating more and more train sets that meet schedules that can fill those trains. And that's what we spent all of our time optimizing. In almost all of our investments, what you will see is the trick we've gotten to is it's not about driving price, which everyone assumes the private sector does. It's very much about how do we optimize the amount of equipment we have for the market we have. And that's where we've made all of our returns in almost every asset. And it usually ends up being a win-win in most circumstances. We used to own Gatwick Airport, where we probably increased 30, 40% operations at that airport and simultaneously increased customer satisfaction. It's really a trick around continuous focus on customers. And so it's been a great experience at Italo over the years.
The European model for getting these high-speed trains built was that the government would build them and then either have a state agency run them or have a private sector entity run them. Total contrast to the freight system in the United States, which was 140,000 miles, all built privately. What are your thoughts? We'll start with you again, Jim, on which model is better, which model is preferable, or what are the pros and, I guess more broadly, pros and cons of those two models?
Right. I think two things. I think there are pros and cons to each of them. I think freight's a different story from passenger usually, because freight you can optimize a schedule, run trains slower, do all sorts of different things, use lower quality track, and that's easier to maintain. The other thing that I would say though about even the U.S. system was a lot of that money was granted to the railroads, and one of your biggest costs is acquiring right of way. And so the railroads kind of got all that for free, which was a huge contribution by the federal government into the rail system back then. And then they sort of washed their hands of it. Passenger is going to have a similar sort of situation. But as I said before, you really don't have globally an example of passenger, in my understanding, covering building the tracks, building the capital, and operating at a ticket price that is acceptable to the market. I mean, the Taiwanese tried it, they went bankrupt. The government stepped in and took a major ownership share. I don't remember how the Japanese work, but everyone else, it was exactly as you said. So I think that there's going to be a need for the government, cast broadly, federal, could be state level governments, to cover those initial capital costs at some level until you can get the ticket price down to something that's reasonable and appropriate. Just like we subsidize highway, just like we subsidize the airports, other things like that.
I think it's worth noting. So if you ask me, and I get asked a lot, will you build me a railroad, right? There's really three things I got to worry about. The first one is how much is it going to cost me to build it, right? I would say in a lot of cases, the US could be almost twice as expensive as Europe is in production. And some of it is just experience of the construction crews, a whole host of experiences that aren't embedded in US big scale projects. But how much is it going to cost me to build? Second, is everyone going to let me do it? Who's going to stop me while I'm starting to pour money into it, right? And then third, if I build it, who's going to ride it? A rule of thumb that we tend to look at is in who's going to ride it is I'm sure you can incentivize people to get out of a car and go into a train, but I have no idea what time scale and at what speed people will make that move. What I do know is if there's an air market, that air market, if there's a good example of a high-speed rail, will shift from the air to the rail.
Right.
And I can bet on that, right? And I can get comfort on that. Some of the markets I've seen this proposed in don't have air markets. So I don't know where I'm going to get my demand from. I'm just guessing that someone's going to change fundamental behavior of moving from a car into the rail, whereas moving from air to rail. As far as having the right of way to build it, that's a big issue. And that's a big question today. It's the same thing that you run into in building. If you want to build a new greenfield national toll road system, that would be, or even just a road system, the right of way would be just as complicated as it would be for rail, right? And then lastly, the build cost. Now that's a harder one. That can be worked on. But if you don't have the first two, why bother on the build cost point, right? Most of the time I've seen these projects put in front of me, they are the most sparkly new design, overpriced, hardest way you could think of building it ever put together. And there are a lot of optimizations that can be done there. So some of the huge numbers I've seen probably could be made better. But if you can't fix the first two bits, it's not worth the effort to look at that last bit. And so that's where some of the government managing that big risk, if it really prioritizes some of these things, helps get the private sector to come into it. And I'll give you a little example to keep in your mind, right? Let's say I want to pick two random cities. Let's say I want to build a high-speed rail line between Memphis and St. Louis, right? For me to do it, I've got to put billions in the ground, buy rail cars, buy all the land, and the first time I put a train on there, I'll find out if I can fill that train, right? And then for me to make that money back, I've got to probably run a train every hour or something like 10 trains a day to get a return on capital of full trains. So I won't even know if the first train works, much less any of the other ones. If I want to move those same passengers with aviation, I'll rent or lease one airplane for a couple of weeks. And if it doesn't work, I'll just run it on a different route. That risk is much easier. That's why aviation spreads so easily in the US relative to rail. If rail is a priority, which in a lot of cases it should be, that risk is a hard bridge in a relative basis for the private sector to bridge. And there needs to be some kind of underpinning to it. Doesn't mean it needs to give value to the private sector, but that risk underpinning is a really, really important point, whether it's grants or it's first loss or other concepts that have been played out all over the world in mega projects, but tend to be left behind in the US. And most of the time in the US, it's usually something about financing subsidies or something along those lines. It doesn't get to the fundamental risk that I worry about when I look at building these things.
So, I mean, going to that question, right, the concern about if they build it, will folks come? Do we think that if in the United States, something like Brightline West gets built and shows it's attracting passengers, maybe Texas gets built because that Dallas to Houston corridor seems like an ideal corridor to have a high-speed train, right? Two of the biggest cities in the country, growing cities, and then it's only 200 miles. If you get that one off the ground, do you think that'll sort of change the risk profile as far as private lenders are concerned?
For me, it's simple. Every situation is unique. I'll speak honestly about Brightline West. I think it's a cool idea. I see the market. I just don't know how easy it is to put a train through the mountains. That just in simple terms, and over the history of the world, it's hard to do. So that remains to be seen. A much easier one for me to look at on the geography is Houston, Dallas. That is a very straightforward build. On an individual basis, I think you can prove that one out, right? And I think you can get pretty comfortable with the risk of the passenger movement, et cetera. And to add to it, it's interesting. I run airports too. Well, I don't, but there's smart guys that work with me that do. We run airports. If we were running those airports, we would like this to occur. It's counterintuitive, but to get those very short haul flights out, and the airlines don't make that much money off those short haul, it's a heavy burden on the environment. It's a heavy burden on operations at the airports. It'd be much better to use those slots for long haul, longer flights, and it would be additive to the passenger mix in those cities. So something along those lines would be a great example, but then you'd still have to look for, I think it would be a great kickoff, but I think you still have to look for specific situations where there is space, where it works.
Okay. Let's shift gears here. We've been talking about private financing and look at the public sector financing. And one of the things that you all heard about yesterday during a couple of the panels was the RIF program. I have to my left here a guy who's probably as knowledgeable as anybody in the country on the RIF program. Why don't you talk a little bit, Jim, about the program, what the obstacles have been, for these passenger operations to tap that program, and what might be done to tweak the program to make it a little more user-friendly for the high-speed trains.
Sure, absolutely. Just as a little bit of background, Rebel currently serves as an advisor to RIF and TIFIA, have for many years. I actually also worked on a number of high-speed rail applications at a previous firm for RIF with Karen Headland when she was there. Unfortunately, couldn't make it today. The background of the RIF program is that it was really created to kind of help out especially the non-category 1 rail lines around the country. Passenger was always a part of it, but I think the real heart and soul of it was the short lines. And so the way that it was initially set up was you were looking for mortgageable collateral. So people would pledge their right of way. They would pledge, their 6 locomotives to borrow to buy 1 new locomotive on a short line. And that was the way that RIF had historically borrowed. Had lended is against a mortgage credit. They had done some loans to Amtrak. I'm not sure what that was collateralized by. And then they've done a bunch of other loans to transit agencies, but all of those are very high quality credits that already have revenues flowing. It's sort of easy to value. So when we got applications in from non-existent railroads that were trying to do something very new in the world, it was very challenging, right? They have a standard where they have to lend to a credit-worthy project. And that's understood to mean sort of around investment grade or better. In TIFIA, you actually have to have a credit ratings letter. You don't for RIF. They're sister lending agencies now, which is why they through the same Build America Bureau, which is why I'm putting the two together. And so the issue was they had to really understand, how do we lend to a project finance business? How do we do the credit analysis? And then at the end of the day, they would do that credit analysis. It would be based on, what was, I think, some pretty good financial work in general. And then that goes to OMB, and OMB sets a credit risk premium that gets negotiated between the program and OMB. That credit risk premium can be a big hangup because it can be a big number on a really risky project. You can think of it as a loan loss reserve for a bank. It's basically money that's set aside, which is the expected loss to the government of this loan, potentially going upside down. And so that became a big challenge. People get upset a little bit sometimes. I think they're used to it now, that at the very beginning, the Buy America restrictions, the Davis-Bacon, the NEPA requirements that get attached to it, that if you're going through them, those are also things that make it a little more difficult to get through. But at the end of the day, it's a pretty arduous credit process. There is this credit risk premium issue that you have in the RIF program.
Explain that for folks.
Yeah, so as I was saying earlier, it's the money that's the expected loss, like a loan loss reserve. A bank always has to set aside 5%, 10%, whatever of its loan value is in cash in case it loses it. And then if they've got 20 loans, one of them goes bad, they're fine. The federal government does the same thing with its loan programs. And so a certain amount of money gets set aside for every loan these programs make. In the TIFIA program, that money comes from Congress. Every year they get a certain amount of money they can put into that fund. In the RIF program, that money has to come from the private borrower or the public borrower, depending on who it is. And then that money goes to Treasury. And then when you're done paying off your loan in 30 years, you get it back, assuming no one has defaulted on their loan in your group. And so that's really where a lot of the issue comes. Now, the benefit of these programs is that it's a really low interest rate when you get it, not counting the credit risk premium. It's got very flexible terms, very flexible draw schedule. It's actually very attractive money when you get to it, but it's not just a free program. And you really have to expect that you're going to go through a full credit analysis process to get to that money.
Okay.
Can I make a comment to that? And then I'll mention it in our side. So we operate around the world, Asia, Europe, Latin America, so on and so forth. And there are various circumstances where we do partake in government-related programs of lending. And most of it is for social benefit or whatever that situation is. But one concept that you'll find, at least in a place like ours, is I just came back from South America 2 days ago. We had bought a port business down there, or bought a 50% stake in a port business down there. We sent 10 people down a day after we closed on it to start a momentum of a business. We have a 100-day plan to get momentum behind the business, because moving organizations is hard. So you need to do it with a great deal of force early on to get excitement in those businesses and get people working in a certain way. whenever we think about these government programs, one of the things that comes ahead is all of that may be great, but if it's going to affect the way the operation of this business, it's going to affect a much bigger amount of cost overruns and other issues. So we need to make sure that whenever we look at a program like this, and it's every single time, we'll have an alternative that we're running parallel. And if this one starts to fall behind, we end up just giving up on it and moving ahead. So when someone's pricing a deal, it's hard to price some of these programs into us putting a deal together because we can't trust that it'll get, I mean, it'll get there, but we can't trust that the timelines will work. So it's hard for even that underlying benefit to be embedded in the way we price it because we can't rely that all that process will hit the timelines we need versus maintain that momentum. And that's one of the tricky things in the private sector we run into.
All right, let's shift gears beyond financing, which has been discussed at great length, to permitting. We've heard over the last couple of days about the delays in the NEPA process. Just a couple of examples in terms of time. The original proponents of the Brightline West, the Desert Express process, took 8 years to get an environmental impact statement for their proposal. When Brightline came in and acquired the project and proposed to move it into the median, Mike talked about that earlier today, a supplemental environmental review had to be done. And we're just about finishing up with that process. In Texas, it took 4 years to get an environmental review done, and it took some more time to get the rule of particular applicability that Administrator Bose talked about. How does that impact the financing? In terms of, we talked a bit about the vicious cycle yesterday. You need to show that you can get past those hurdles before anybody will lend money on a project. But if it takes you a year or two to get the money after you finish the environmental impact statement, somebody will come in and say, well, your environmental impact statement is now stale and needs to be re-supplemented. Okay. Meanwhile, while you're doing that, you're back at square one. The cost of the project goes up. So it's kind of a vicious cycle. Just wanted to get your thoughts on what proponents could do or what government could do in terms of changing the process to kind of address that vicious cycle.
You want to go first or no?
Have
I mean, I think in some ways it's hard to avoid. I think that what you would love to do is you'd love to have design sort of be at a level that you can go to the lenders with at the same time as you're finishing your environmental impact statement. I think that would be the ideal situation so that you don't have this delay. What you don't want to do is you don't want to go get your EIS, then spend 3 years in design, and then go get money. But until you have a real estimate of your cost, which means you've got a real design and you've got the big permitting risks out of the way, the environmental things, the other things like that, no financier is going to really look at you credibly. I mean, everyone will take a meeting, say, sounds like a great project, come back when you've got these 4 things knocked out.
And you kind of lose your credibility. I mean, in the case of the Texas project, originally it was estimated to cost about $10–12 billion.
Right.
But they went through this lengthy delay that we spoke about a minute ago, both for the rule of particular applicability and the NEPA process. And by the time they got finished with that, the price tag was close to $20 billion. Right. And you lose your credibility with lenders as well. So it seems to me that we need some sort of a cap or limitation of the time that government takes, so that if it's going to take you 2 years to finish your environmental, maybe a year into that process, you're just a year out, you can start the process of obtaining financing for the project with less risk that it's going to, the environmental process will go longer and the cost will increase, and suddenly you have to increase your ask for financing.
Yeah, I'm not sure that increasing your ask is really a problem usually. Like, people upsize deals, as long as the risk of the deal hasn't changed. There's a lot of capital out there for infrastructure projects right now. So I think the real issue is that environmental approval going stale or getting challenged in court or things like that.
Before we get to Ray and the preemption issue, I got one question I want to ask the two of you, and Ray, you can weigh in on this as well if you want. The original Transcontinental Railroad in the 1860s, Congress supported it financially by allowing the railroads to issue bonds backed by the credit of the federal government. And the way the program worked was they were allowed to issue so many bonds, they had to complete miles of track. Once you complete this many miles of track, you could get some more bonds and more bonds and more bonds. What do you think of a federal financing program that's sort of based on performance in that way, that if you stay on schedule and you build X number of miles, the financing comes incrementally? Because one of the things we've heard about over the last 2 days is, for example, with the current $4.5 billion, certain award winners are going to get their piece of that this year, but they have no guarantee, for example, for California, that they're going to get a piece of it next year or the year after.
Right.
And Brian Kelly, spoke pretty eloquently yesterday about what a problem it creates for a multi-year project like that. So what do you think about a program where the government says, okay, here's your allocation for this year, show us, and you have milestones for completion of portions of the project as opposed to spending the money? I guess right now the way it works is you have so many years to spend it. Okay, but that doesn't really necessarily accomplish anything in terms of actually getting assets in the ground.
Yeah, I mean, the way the programs work right now is you'll have up to 5 or 6 years to draw on the facility, but the facility's there. And so that's basically, it's basically what happens is you get through your various stages and then you draw down the money and get it. So it actually does work a little bit like that. There's no federal guarantee
Right.
of the money. The real issue would be is if you delay beyond your last expected draw date, that can be a problem. But right now there are actually conditions precedent for a draw that you have to be hitting certain milestones and making certain progress in the projects.
John, you have thoughts on that?
Yeah, it's simple. I, however you want to dole out the money, fine. If I've got equity risk on the line, I'm going to run like a sprint. The issue I run into is, it goes back to the point previous that you were saying, which is in effect, regulatory certainty doesn't exist in the US at the moment when you're doing construction. And you could talk about all the countries in the world and put them on a list of who's got regulatory certainty and where it's investable. Regulatory certainty building over spaces of land isn't clear. And because of that, you could set that clock to me, but I've all of a sudden got things that are popping up that are regulatory issues that will slow me down, that are outside of my control. And that's more of my problem than whether or not the doling out rate or pace or getting a little bit of credit to the US government. Ultimately, you're going to come back to what I said earlier on is that the risk of doing this is so great, it's probably beyond the economics, except for in certain circumstances. I think Houston Dulles is worth a look, fair look. I think it's worth a fair look, but it's not everywhere. First loss of government or grants, but they have to be incentivized grants. They can't be just here, good luck.
Right.
It really does. And I don't think there's anyone in a place like myself that's not happy to take that risk. We make massive build. If we go over cost, that's our problem. But as far as little bits, tweaks to it, what happened 200 years ago, that was a different animal. I don't think that's really the problem, because capital is not, I mean, it's always going to be an issue, but tens of billions isn't a problem for us. We're putting for lack of a better word, windmills in the North Sea and all over the world. Those are big projects, but we have regulatory clarity out in the ocean. It's our problem to figure out if we can stick a stick in the ground and put a fan on it.
Right. Speaking of regulatory clarity, it's time to hear about preemption from Ray. I'll set the stage. One of the problems is that take the Dallas-Houston program. The folks in Dallas love it, the folks in Houston love it, and the folks in between, don't like it because there's not going to be a station in their town. Right. There's going to be a dirty construction project that's going to, screw up their streets for a period of time, and they're never going to have train service. Right. And a bunch of trains will blow through their town and not do them much good. And as a result of that, what you sometimes see is state and local governments try to throw obstacles in the way to try to slow the project down. Even if they don't defeat the project, the fact that they slow it down for a number of years raises the cost and makes the financing more difficult. It's that vicious cycle again. So Ray, why don't you talk about why that's not a problem on the freight side in the United States, and explain preemption, and then we can discuss, what might be done to help on the passenger side.
Sure. So I appreciate being invited to speak. I'm not sure how many lawyers are in the room, just out of curiosity, just so I gauge my audience.
How many non-Sidley lawyers are in the room?
Yeah. But
The rest of you go back to work.
The high level. When you're thinking about the freight rail system in the United States, you probably know there are two principal regulators who regulate, one on the safety side, one on the economic side. So you've got FRA, who regulates on safety. You've got the Surface Transportation Board that regulates the economics of how rails operate and interface with their customers. For a long time, Congress has recognized for this interstate freight rail network to function smoothly and efficiently, you can't have a patchwork of conflicting safety or economic regulations being imposed on the freight rail system by every state and local jurisdiction that they operate through. And so for decades, Congress has provided for what we call preemption of state safety and economic regulatory activity of the freight rail system. So for that to take place, fundamentally, you need a project that is subject to federal jurisdiction. So if it's entirely within a state and it's really not touched upon interstate the network, you don't get this protection, this umbrella of federal preemption. And then Congress would place certain requirements depending upon the nature of what the state is trying to do. So on the safety side, in order for there to be preemption, you need the FRA to have stepped into that space and offered federal safety regulations to cover the subject matter. In the economic side, it's a much broader form of regulation. One of them in particular that's interesting and relevant to new high-speed rail projects is the preemption of state and local permitting processes. So if you're a freight railroad and you're contemplating designing a new line to enter into a new market, you may or may not have to go to the STB to get approval, depending on the board's rules. But because the STB has jurisdiction over the project, you don't have to go and get permits from every state and local authority through which this new line is going to operate. It doesn't mean that those authorities don't have an opportunity to offer their perspective on the project and raise their concerns, but the permitting process has been centralized with one federal agency, the STB. Now, maybe the STB has to coordinate with the Corps of Engineers or Fish and Wildlife. There may be other federal permits that you need to get for that project, but then they all do a collaborative effort to do the environmental review and to give you the series of licenses. But what doesn't happen is state and local officials denying you a permit to operate along that particular stretch. In the high-speed rail area, what we saw with Texas Central, so Texas Central needed to go get essentially permission from FRA to operate. So that was one set of permits, and that's where the environmental review was triggered. But they also, because of the nature of the project, believed that they had to get STB approval as well, and getting that approval would have preempted the other local officials in Texas from imposing their own permitting process on the project. An area where, in my view, we could see some improvement to help reduce the degree of regulatory risk that private investors don't want to see is kind of twofold. The first is it took forever for the STB to assert jurisdiction over the Texas Central project. It was a slog. It was, part of the problem is that there's not a lot of high-speed rail in the United States, so there's not a lot of precedent that the agency could use, and its precedent is kind of all over the place. So you've got the Desert Express now, Brightline West, where it's not connected to the interstate rail network, but as long as it crosses a state line, the agency says it's subject to our jurisdiction. You're like, okay. And then you've got in California where they asserted jurisdiction over it because there was lots of interaction with Amtrak, no real joint ticketing arrangement, but lots of shared facilities. So that was enough for the STB to assert jurisdiction. But when you have Brightline in Florida, which was entirely within one state, the board said we don't have jurisdiction over that. So when you're advising a private investor about, well, you know, are you subject to the board's jurisdiction, or are you going to be subject to the jurisdiction of every single local community in the state? You don't get a lot of guidance. It turns out in Texas, we went in once and said, this is clearly part of an interstate rail network. Just look at a map. You know, you could see the Amtrak system. You could see this gaping hole between Houston and Dallas. They were going to be within 800 feet of the train stations. You could get a cab, or they were going to be, you know, we're going to provide services to get there. And the board, in its infinite wisdom, said no. But then it gave us a little guidance that said, well, if you ever enter into an agreement with Amtrak for joint ticketing, that will be sufficient to create jurisdiction. So what did we do? We immediately entered into an agreement with Amtrak for joint ticketing. Now, keep in mind, this is a project that wasn't off the ground. That joint ticketing arrangement wasn't likely to actually be realized for years. But then we went back to the board and said, well, that's, you know, we disagree with your first decision, but, you know, now there should be sufficient nexus with interstate commerce for you to assert jurisdiction, which they did do. But then they added another problem in terms of the regulatory hurdles, which is now we need approval from the STB to construct the project. And the board said, well, we want you to put a full application in. We want to know all about your financing. How is this project actually going to be financed? Where's it all going to come from? To which we responded to the agency, you got the cart way in front of the horse here, folks. Like, we need to get your approval so that we can actually then take this project to the market to get the financing for it. If you're going to put that requirement before we get your approval, this project isn't going to go anywhere. Now, I would say that's still in play at the moment because, you know, Texas Central went into a period of dormancy. I don't think it's dead. So we may be revisiting with the STB. But the areas I think the federal government could help to try to simplify and make it clear is, one, give us some guidance on what is subject to your jurisdiction and what isn't. You know, at the moment, we have FRA taking jurisdiction over these federal projects, including Texas Central, under a very liberal standard of what is in interstate commerce. But then you got the STB taking a much more stringent standard. These are two sister agencies. You would think they should have a joint view of what is or is not a federal project. And then the second thing I think they should do is make it clear how the process is going to run, how this permitting process is going to run. Make it clear to investors up front, not like, well, we'll tell you when we see it, or you'll learn the experience on the joy of going through the process, but actually up front, setting forth some really clear guidance. The third point I would make, and this is really just inside baseball for those of you, but when I go to a client comes to us and says, this is subject to the STB's jurisdiction, I say it might be or it might not be, we think it should be. They say, great, what does that mean? Well, it means, you know, you don't have to get this permitting process. They say, that's great. What else does it mean? I mean, you're telling me I'm subject to the jurisdiction of the Surface Transportation Board. What do they regulate? Well, they regulate rates and service and unreasonable practices. And I can see the look of horror in the eyes of the investors. Like, are you telling me that I'm subjecting myself to an agency that's going to be regulating my service and my routes and my rates? Well, the reality is no. The STB recognizes that its role in regulating passenger services should be quite limited, but the statute's quite broad. So they create these exemptions. With each passenger service that they take jurisdiction over, they simultaneously say, we're taking jurisdiction, but we're exempting you from virtually every part of our regulatory system that really just applies to the freight railroads, which is very logical because the STB is set up largely to protect customers, freight customers who have no other option, where there's not a well-functioning marketplace. Well, there's a tremendously well-functioning marketplace for transporting passengers around this country, whether it's roads or buses or, so there's really no need. But I personally think it would be advantageous for the STB to not do this on a piece-by-piece basis, but actually say upfront, okay, if you are subject to our jurisdiction, what does that mean? Well, and they can do it. They can say, we're going to exempt passenger rail from the following requirements of our statute: rates, service, unreasonable practices, all the ones that no investor wants to be told that they're investing in a project with the rates and the services and the routes are actually subject to review at the STB. So that's kind of at a high level. I know, Terry, you might have some follow on.
No, I want to take a minute or two just for questions. Folks may want to ask questions of our panelists here. Keith?
And no questions from anyone that works for Terry or me.
Hi, gentlemen. Dan Richard. I'm a former chair of the California High-Speed Rail Authority. A quick comment and a question. Comment on preemption. STB did take jurisdiction in the California High-Speed Rail project. At one point, our state attorney general said, "Oh, we read City of Auburn," meaning that there's no California CEQA requirement. We had split decisions from two different appellate courts, and it was not appealed, probably for political reasons. It would have been nice if STB had intervened and said, "This is what we see in terms of our authority." They did not. So I just endorse your comment that getting some clarity from them, but I mean, it would change the ball game everywhere if they did something like that.
Can we get a question over here?
Oh, he had a question too.
On financing, and I'll keep it short, but also on California High-Speed Rail, we were handcuffed by our bond act to not be allowed to pay any subsidies for operation, because the theory was that these projects, once they're built around the world, operate with positive revenues and cash flows. I always wanted to try to push that, but I guess my question would be, without asking you to be specific, is there a way to sit down with the private sector and think about what types of state support would allow people to come into a project earlier than after we've already established a level of ridership? Because I mean, my feeling is that would take decades to get the market comfortable with that level of ridership information. Whereas if we could offer some kind of safety net in the early years, maybe with the understanding that there's payback, et cetera, is that a fool's errand to think about that kind of conversation with the private sector, or is there some possibility there?
It's going to be situation specific, but it's not a fool's errand at all. I mean, I was part of building a new airport with, that's going to be dependent on routes. There's a host of things where we can look at. It's simple. Human beings act in a certain way. They need to move between certain places. And behavior can be pretty predictable. The movement to rail. Now, if I'm betting on everyone throwing their car away and jumping on a railroad, that's very hard. But there are circumstances. That's why I use the rule of thumb around an air corridor. There are dynamics where we've got history of it. Look at the Eurostar. So between London, Paris, look at Milan, Rome, look at even the Northeast corridor. That air market's come out a lot. So there's plenty of backing that there's an area where we can take that risk. We don't need perfect information, and taking a demand bet is not impossible.
We have a question over here.
Well, if I can just respond to, like, I don't disagree that legislation is always a wonderful way of solving problems, but it's given how difficult it is oftentimes to get Congress to move in a predictable way. I'm just focusing on things that the regulatory agencies can do right now. And I honestly think that the STB and the FRA have enough authority themselves to issue these policy statements that clarifies the scope of what they're doing. Why wait for Congress to step in and do what I think? Now, it's not, there's limitations on their authority, which is in the statute, but the authority that they've got and that they've asserted, and no one seems to, is the authority over the construction and operation of high-speed rail lines that are part of the interstate rail network. And they should just tell people, what does that mean? And how do you get it from us? because they can't rely on a body of precedent. Their precedent in passenger rail ended about 1950, and the precedent before there isn't really particularly helpful in the modern age of high-speed passenger rail.
Hey, I just gotta say to Rich, I'm crushed that you don't like the all aboard decision. I helped get that one. I helped get that one for my client. Maybe room for one more question before Keith?
Nope.
Keith? Oh, we have, okay, go ahead.
Dave Kiefer. You brought up a little idea that I might not really find much support for, but a lot of tech companies have what they call a portfolio. They like sustainable, renewable things in their portfolio. And I think Amazon moved to Washington State because of a proposed rail line or whatever. Or you see a lot, I travel a lot of interstates. You see a lot of parcel package companies like UPS and Amazon Prime and all that stuff. So would you be able to get these guys to offer, or would you be able to offer them something to go into their portfolio that might help them get carbon neutral by 2030 or whatever? And I might be able to get some of these trucks that are not hauling commodities like grain, but maybe parcel packages. I think somebody brought that up one time that, you know, on the off-peak hours, we could probably fill those trains full of envelopes full of toilet paper or something or whatever in there. But anyway, that's kind of a thought.
From my standpoint, 100%. That's what I do. When I need to figure out a project, I'm going to figure out every one of those angles and go bring those guys together in order to put together a project like that. That is exactly what I do. But so that's, you know, when in many ways, you look at me as an arranger of capital. Once I go above, I don't know, 5 billion or something, I'm not only writing out of my fund. I'm getting a lot of friends and family to come together, and we can get big numbers. And now those are areas where we spend a lot of time. This isn't the right forum, but when I put together some consortium bids, some of them have been public fights and other things. We get involved with every stakeholder because that's how we ensure and get comfortable with the risk we're taking. But not only that, improve the return we can get out of it. So yeah, absolutely.
Keith, I know you've been chomping at the bit to ask a question here. Go ahead.
That's great. I had the great pleasure of spending a week with Ethelot and Trenitalian last summer. And with your addition to the market, even though it's a duopoly, frequency is higher than it's ever been. Ridership is higher than it's ever been. On time is solid, and EBITDA for both the operators are up. So it's that secret of competition. As far as concessionaire, what's it going to take in the United States to where it's we would hope for a duopoly. Right now, we're looking at a monopoly if only one concessionaire is operating that asset. And in the transportation world that I live in, we always use the term, we want that asset to sweat. We want it to do as much as it can all hours of the day. So it's diminishing that depreciation or the overall utility of the depreciation. Do you see a United States with a duopoly? Do you see us having competition on the high-speed rail lines?
So actually, I don't. And there's a lot of reasons for it. First, there's a much more intense alternative space in the US for transportation, whether it's auto or plane. The duopoly in Italy, funnily enough, to be, probably shouldn't be quoted on this, but I don't really look at it as a duopoly because our structural cost ability, our ability to structurally lower costs means that we're just a price taker into what they're willing to bid. Where we have driven that business has been in identifying at a very narrow level what hits exactly the most useful times to send our trains so that it fits the patterns of the public. But I don't think that's a competition thing because I can show you we did that exactly at Gatwick Airport in creating slots where we had no competition. It's more around what the incentive base is for us. So in both circumstances, we're not really optimizing price, which is what the competition driver is. We're always optimizing volume through the business. I don't know if you know that much about our background. Our background was a JV between kind of a finance institution and GE. So we're full of engineers, and all we do is optimize utilization and density of activity on our assets. And it doesn't matter what that asset is anywhere on the planet. And so that's where that fits out. Now, I understand that it looks like a competition, but it really isn't so much a competition. It's about we have available space. If we can optimize that between our costs. In the US, I think it's harder. First of all, you've got so many other competitions that you're going to drive down price to a point because there's going to be oversupply. Because what's going to happen is somehow you're going to get over subsidized and oversupply, and you're going to put pressure on anyone being able to put together a good product. I think that comfort now, maybe 50, 100 years, I don't know, I can't speak to that. That's my view. And I'll tell you the other trick. It's an important one. because we see this and this one's actually an important one that, because what you're talking about is actually open access, which if I said that in a room full of cargo rail guys, the freight guys would lose their mind. I spent a lot of time with these guys. We run an open access railroad in Australia. Okay, this year our profitability, EBITDA went down 25% because there was a large rainstorm that washed out the tracks. I can't think of a number of times in the US where tracks have been washed out and you have over 2 months of utilization because the operator of that track is independent from the railroad and didn't put enough. Because if I own that track, I would have over-engineered that track because 2 months of loss of operations is not acceptable. But once you get to like an open access problem, you start to get all different incentives that might naturally not be good for the market. Now, I'm not arguing for or against open access, but there's a big danger to it that we've seen in that market and with that concept.
Thank you all. Thanks to the panelists for staying with us.